Hello friends, hope you're doing well. Chris Lee, CPA here with another video for you. So today we are going to talk about a tax strategy to utilize if you own company stock, and that company stock is within a 401k account. So if you, let's say we've got an employee that has company stock in a 401k plan. So maybe you work for Apple, you've got a 401k with Apple, and within your 401k plan, you own Apple stock directly, not through a mutual fund. You own a piece of Apple stock directly within your 401k account. The stock, let's say it has a $10,000 cost basis, and now it has a fair market value of $100,000. And so you bought this over a series of years, and you've seen the huge appreciation. And so when this employee goes to retire, oftentimes you'll see the person take the full amount out of their employer 401k account and roll it into an individual retirement account or IRA. That rollover is a non-taxable transaction. And then in subsequent years, the employee is going to sell some of that stock and take some withdrawals. And the thing is here is when those withdrawals come from that IRA account, it's taxed as ordinary income tax rates, not the favorable capital gain rates. So when you've got this employer stock in here, we have some special options that we can work with. So fundamentally, all $100,000 of those distributions would be taxed at ordinary income rates, and even the appreciation on those assets, unlike if you held it in a taxable brokerage account, gets taxed where it gets taxed at long-term rates coming out of a tax advantage retirement account on a pre-tax basis. It gets taxed at ordinary income rates. So we have an alternative to this problem as it relates specifically to company stock of a company that you've worked for. So instead of rolling over the stock, the company stock from the employer 401k plan to an IRA, you can actually transfer that stock into a taxable brokerage account to achieve some benefits. So stick with me here. In the year of the transfer, you're going to have one problem. You'll have ordinary tax applied to the cost basis of those assets. So in our scenario that we were describing, $10,000 getting taxed at ordinary income rates. But you've got that $90,000 sitting there that is, appreciation that doesn't get taxed on that transaction from the 401k to a taxable brokerage account. Now, the big benefit here, as I noted, there's no tax on that appreciation, that $90,000 kind of like net unrealized appreciation, as we refer to, as the fair market value minus the cost basis. So that net unrealized appreciation is not taxed when you do a distribution from the 401k to your personal account. But what does happen is rather than that, that first 10,000 was taxed at the ordinary rates. The next 90,000 though, you pay long-term capital gain rates regardless of the holding period or what happens next. Like that net unrealized appreciation becomes long-term capital gain assets. So you don't need to hold that stock for that net unrealized appreciation for a year or anything after the distribution. It just becomes long-term capital gain treatment no matter what. The added benefit of this net unrealized appreciation is it's not subject to the net investment income tax, that 3.8%. So that net unrealized appreciation in our example, the $90,000 is going to be long-term capital gain rates regardless. Now, any additional appreciation on that stock at the time of sale is going to receive capital gain treatment. However, it's not automatically long-term capital gains. We then, for anything above, anything that's above that net unrealized appreciation is going to be taxed according to our typical holding periods and whatnot that we see with capital assets. And so that is to say, stock held for more than 1 year is going to be long-term treatment. Stock that after the distribution is held for less than a year and has any additional appreciation will get taxed at a short-term rate. So, but the good news is that net unrealized appreciation doesn't have the net investment income tax. And so that's really the big benefit there, is that net unrealized appreciation can always have that net investment income tax. The good news too is that these distributions are likely are special in-kind distributions, and so you don't have to pay tax on all of the amounts. And so thinking about this a little bit more, like in the numbers, let's say that same employee has stock that's worth $100,000. They paid $10,000 for it in their 401k. They go ahead and distribute these shares, exercising a net unrealized appreciation strategy. So in the year of the distribution, that $10,000 basis gets taxed at their ordinary tax rates. Let's assume it's 22%, so they pay $2,200 of tax. And then that same employee has $90,000 of net unrealized appreciation until the stock is sold. So when the stock is sold, it will be taxed presumably, in the 15% long-term capital gain tax rate on that net unrealized appreciation. So 15% on the 90,000 gives us a $13,500 tax. So in total, on the $100,000 from the sale of that stock, the tax paid is $15,700 instead of, had that been sitting in a, tax deferred account and $100,000 coming out at ordinary tax rates, it would have been $22,000 of tax. So we're saving a little over $6,000, $6,300 by executing this transaction. So it can be a meaningful benefit, and honestly, this is scalable depending on your facts and circumstances. But nice, easy round numbers here. So there are several requirements that have to be thought through. So first, the distribution must be of employer stock held in a qualified retirement plan, so 401k or an ESOP. It doesn't make a difference whether or not your employer contributed the stock or you purchased it yourself within the stock. So say you work at Apple and you're like, I want to own directly Apple within my 401k. Either way, that's fine. You don't need Apple to contribute the shares to your 401k for this to work. Stock held within a IRA account of any kind, traditional SEP, simple, any type of non-qualified deferred compensation plan is not eligible for the net unrealized appreciation treatment. A few things about how it gets distributed. It must be distributed in kind as part of a lump sum distribution and following a triggering event. So you must distribute the stock in kind to a taxable account. This means you must transfer the shares directly to your brokerage account. You can't sell the shares and transfer the money, or transfer the shares to your IRA account and then to the taxable account. It must be in kind from the 401k account to the taxable brokerage account. The stock has to also be distributed as part of a lump sum distribution from your employer retirement plan. So to qualify, you must distribute your entire vested balance and all the assets from your qualified plans you hold with your employer within the same calendar year. So you don't have to withdraw all at once, but your account balance must be zero by December 31st. You aren't required to transfer all your plan assets to a taxable account. You can roll some assets into an IRA or the 401k plan for a new employer. And you can, for example, you can roll cash or mutual funds into an IRA. Also, you don't have to transfer all your employer stock into the taxable account. So you don't have to use the net unrealized appreciation strategy on all of your employer stock. You can use it, you can transfer some and roll the rest into an IRA, which means you can cherry pick the lowest basis shares to do this kind of net unrealized appreciation distribution strategy, this NUA strategy. So, and then there needs to be a triggering event. A lump sum distribution must be made after a triggering event of, you turn 59 and a half years old, you terminate your service with the employer, or you die or become disabled. So once you reach 59 and a half years old, you qualify for a lump sum distribution at any time. If you're still employed, your company plan must allow in-service distributions. So that's to say you're still working for the employer and but you're planning to keep working, but you're gonna, get those shares out now rather than later. And so the plan must allow for in-service distributions. Not all 401k plans allow active employees to take distributions from the 401k outside of maybe if there was an RMD or something that applied to that account. So if you take your lump sum distribution before reaching 59 and a half, you'll have to pay the 10% penalty, early withdrawal penalty on your shares cost basis, not on the fair market value, just on the cost basis. But there is an acceptance of penalty if you leave your employer after reaching age 55. So when it comes to estate planning, there are some benefits for this net unrealized appreciation strategy. So when you distribute your company stock to a taxable brokerage account, the benefits is not that it's the stock is not in an eligible retirement plan. It is not subject to ordinary income taxes on required minimum distributions that apply on IRAs or inherited IRAs and other qualified retirement plans after you reach your required minimum distribution fees. That means that all the stock in your brokerage account, you can keep it all in your account until you die, and your heirs can receive a stepped up basis in the appreciation of the stock during the time you held it in your taxable account. Your heirs receive no date of death step up and basis on the unrealized appreciation. The NUA is going to be taxed at capital gains rates to the heirs, but the remaining elements of the stock does get stepped up. So is the net unrealized appreciation treatment, for you? Maybe. The larger your net unrealized appreciation, the more tax you'll pay. You'll save with the capital gains treatment. As a general rule, you want your stock basis to be no more than 25% of your fair market value. The tax due on your cost basis is going to be an upfront hit. So if your cost basis is substantial, you could move yourself to a higher tax bracket. And so that marginal tax rate on those dollars might be higher than you would expect. And if you're relatively young, and this usually isn't the right strategy, you can keep the stock or its proceeds in your IRA, where it can grow tax deferred for many years. The NUA treatment really is of value for multi-year tax deferred growth. The value of the multi-year tax deferred growth can exceed the benefit of the capital gains treatment on your NUA if you're younger. But if you are at or near retirement age and want to sell your company stock soon, the net unrealized appreciation strategy can work pretty well. Electing an NUA treatment also isn't advisable if your income tax bracket will go just down substantially when you retire. So if that's something, oftentimes we'll see that, but that's not always the case. So if you expect a lower tax bracket in the future, then we probably don't really care too much about all of these different steps. So key takeaways here. So if you're an employee with company stock inside of a qualified retirement plan, you would usually roll the stock into an IRA when you retire and leave. With this rollover, rather than having a tax-free rollover, you will pay ordinary tax rates when you take money. You're going to pay tax on this net unrealized appreciation. Usually, when you roll over those dollars, you pay ordinary income tax rates when you take the money out of the IRA. So with the unrealized appreciation rule, again, instead of rolling the stock into an IRA, you elect this treatment by transferring the company stock into a taxable brokerage account. You pay tax, the ordinary income tax rates on your cost basis in the stock, but whenever you sell that stock, you pay tax on the appreciation at more favorable rates. To qualify for the treatment, you have to transfer all your vested retirement plan assets as part of a lump sum distribution made after you reach the age of 59 and a half. Leave your employer or die. Because the NUA stock is not in a retirement plan, it's not subject to the RMD rules, which is huge. A lot of clients I have are managing RMD rules, like managing RMD consequences that are forcing them into higher tax brackets than they might have actually realized. You can keep it in your account until you die. You're not going to be forced to distribute it because it's in a taxable brokerage account, which is, fundamentally unrestricted. So your heirs get then a stepped up basis for the appreciation of the stock during the time you held it in your taxable brokerage account. So the net unrealized treatment is fundamentally going to be best for older employees who have substantial appreciation in their company's stock. And again, we usually want that cost basis to be no more than 25% of the fair market value. So if it was $100,000 and the cost basis is, more than 25, if say the value of the stock when you're considering a transaction is $100,000 and your cost basis is more than $25,000, we're probably going to just like scratch this from the start, just because ordinary tax rates on that basis is going to be pretty high. And then we're looking at, how the capital gain rates are going to work for you. So anyway, something to think about, some thoughts for financial advisors, that it's kind of worth maybe asking them the questions. If they have taxable brokerage account, making sure that they can receive the in-kind distribution and all those sorts of things. There are some other technicalities of how all of this would work and that sort of thing. But yeah, just remember that the key thing too is that not all the stock needs to, so not all of your employer stock that you have in your account needs to use this net unrealized appreciation strategy. You can actually pick and choose which stock's going to, that will be the case, and then go from there. So if you're finding that 25% value on the bucket of dollars, look at the actual individual holdings and see how are they bought, what is that looking like relative to the current value, what's the basis. Like, you can look at it at a much more granular level than just saying like, here's the apple, here's the cost, here's the fair market value. Doesn't work. It's like, well, if you block that over a series of years, this might still work for you. So just remember those details if you want to have a direct consult or get in touch with me. Link down in the video description, and I will have another video for you soon. We'll talk about another fun tax topic. All right, take care. Bye, friends.